This trading student made $3,000 that are real within 5 months learning this trading strategy. The cool thing also was about it, between Monday and Friday, he was trading sometimes 2 times, sometimes 4 times, 5 times a week within only 1 or 2 hours. I'm going to show you here the performance. You can see how he made $1,363 in November, and you can see here how he made $1,763 in October. I'm going to show you the money management he did, the trading strategy, and what can you use for you as a beginner for your own trading. First of all, very important is the money management. You can see how he had 4 losing trades, lost $461 in performance. How he has 6 winning trades and made $2,224. So here's the thing. If his average of losing is $100 a trade, and he has 6 trades with a winning of $2,224. That means he could now 22 times lose $100 before even he would start losing money. So even though he has only 4 losing trades, he could afford himself even more losing trades. And you can see here $1,775 with 6 winning trades. So that means he could afford 17 losing trades. Even though he had only 4 losing trades here, also, he could afford himself more losing trades, right? So that's the very important thing for the scalable thing, because there's something that is called the profit factor. And this is in between the minus 461 in reference to 2000 is, as you can see, 5 times of the amount. That means his profit factor is 5 times. This is something what we want to hold low as possible. Why? Because if he would trade with now $1,000 a trade or $500 a trade, instead of saying $461, it could say he would lose $4,061, but he would have made $20,000. This is just something what is a very important number that would help himself not from breaking his trading account. So I was preparing here some trade examples, and there's a 3 simple step process. Rate of learning is being defined by how many kind of habits can you learn, like literally just like gaining that knowledge. That means here, for example, I'm going to give you a step-by-step process, a 3-step process that you can use for each time you're trading on the computer. Intelligent is being measured. How long does it take? How many weeks, days, or hours, or minutes does it take that you take notes on this, what I'm saying, for example, and you can execute it on your trading platform. We use TradingView because TradingView can be free traded over a demo account, the not real money account. And TradingView can be used also on the free version by trading it with a real money account, what is absolutely awesome. Trader pay you thousands of dollars for other trading platforms, but I mean, you can use TradingView starting $300, $500, what is absolutely cool, instead of paying TradingView $500 to trade with real money. So this is something what is really cool, but please use a demo account first. You can also trade with TradingView using a demo account by going into US 500 is the mark, or like Euro, US dollar, for example. So we always make sure that within the session time, we trade for 1 or 2 hours, free selectable. Why? Because it should be first part-time based. It should not be your full-time job, like putting yourself under too much stress. That means your main income is something what is very important, and then doing this one on the side. But if you are a trader that wants to build your trading as a main income, for example, if you're an entrepreneur, if you're a business owner, for example, and you want this really to work, so you can work from home, for example, so you're your own boss. Let me know, by the way, in the comment section or under the comment section, you'll find a link and you can apply there for the training with me in person, because I do mentorships. That means coachings where you learn, where I giving you tasks, where I trade with you together, where I'm implementing this. And so far, trading students within the first 3 to 7 months are able to apply this trading strategy with a demo account, and some are even with real money. So this trading student is learning already since 5 months, as I just said. This is the MES1 exclamation mark. Why we use this? So we can use money management and adjust $100 or $10 a trade is something what is very important. That means we can increase from small to big. This is something what is very important. Step number 1, we select between 9 a.m. and 4 p.m. Central Time. In the New York time, we select a 1 or 2 hours. Step number 2 is that, step number 1, we select a 1 or 2 hours. We make sure that we first have these 3 things I meant. We have here this square. I'm going to show you this one here now on my right side. I need to do it like this here. You can see here that you have here this square. that he has here the square, and the square is his trading time. That means when you just look at his trading time here from here to there and you replicate it at the back, that means like from here to there, then the thing is, then you can see in the last 1 or 2 hours the market was doing this length up. If you would just copy and paste this picture here, then it would look like this, that the market would continue to go up. This is the S&P 500 future, and the S&P 500 future is running for 30 minutes, 4 hours, 5 hours just in one direction. So what we do is we use 3 things. The first one is we use a zone. We do it in front where we cannot see the future. We compare it with the last 1 or 2 hours that we see if we trade now for 2 hours, what move makes sense. And you can see here if the market is this length within the last hour, it makes sense that the market does the same length again. The second thing we need literally is the path, because we're going to draw in just like what we see past hour to right now what makes sense. And when doing this more often, then it will change with your experience. That means how far can the market go? Where do you expect the market is going within the next 25 to 45 minutes is something what is very important. He expects the market is going up and then it goes down. That means that the market does this length again, or for example, this length again, as you see here from here to here, and then somewhere here that the market turns down, right? The third thing is in that area, do we have a key reference? For example, here you can see all 3 things. You can see here, number 1 is here again the time, number 2 is the path, number 3 within this length it makes sense that the market goes to this bigger structure low. Number 1 is always where is the bigger structure low or high do you see the market is going at. Highest point is here, lowest point is here, as you see here. So where does it make more sense that the market goes when the market is here? And clearly you can see that the market does this length down for once, for a second time this length, for a third time this length. So if the market does 1, 2, 3 times this, almost the same length, if the market would do here the same length, it would be very realistic that the market goes to this key reference here on the left side, but not to this key reference here on the top, because this is too far away. So this is what the trader was drawing in while trading. Also when using the path tool, using TradingView, it makes sense. Then it helps sort of as a reminder, because while you trade, you can draw this one in and you just look at the market. It means at the beginning, you make this picture with first the time, the square, or you'd make 2 vertical lines. Second, you put a path tool, just like a drawing in, where do you expect the market is going within the next 35, 45 or 2 hours, 25, 35 minutes or 2 hours. And the third thing is then in that range, what key reference do you have? Where do you expect the market is going? Do you have a bigger structure low? Do you have a bigger structure high? Or if there's nothing, if the market did a couple of times like lengths like this, and it always does problems, maybe down here the market cannot reach also the low and does any problems here, for example, right? So that means the best way to trade the length is in this area here where the black line is. And this is where we go then to step number 2, right? So first of all, we do the first picture. Second one is then what does the market do after? And you can see here how the market really was going down to this point and then also was reversing. The trader assumed it's going down here and it's reversing, and that's also what the market did. The market was going down here and was reversing, right? So how can we see this? There's a 3-step method. First of all, it is to identify bigger structure highs and lows, as I just told you. Second one is then, can we see now that the market has more green or red candles? And here you can see, obviously here, for example, on this day, the market here does more green candles. That tells us it makes more sense to trade up. They're in between these 3 things. If you have something to write down, take yourself notes. This is something what is very important, because it's very hard to have everything just on your mind maybe. Just get it down on paper. I'm trying to also draw this front for you. That means first one, we can see here the market is trending. Second one, we can see that the market is structuring higher. And the third one is that we have here a consolidation phase, that the market is getting harder and harder to trade. And the thing is that number 1 goes to number 2, number 2 goes to number 3. Let me explain. If you have a bigger structure high and you can see that the market has lots of green candles and you start trading here and you put your square in front, you say like this is 1 hour, so that you can measure like if this is the 1 hour in front, how does the 1 hour in the back was looking like in the past, so you can see how much cash flow you have. This is something what's very important. Then why I'm going to explain this to you, because you want to see first that it makes sense if you sit down for 1 or 2 hours, that you can see that the market has a move within $1,000, $2,000, $3,000. If you would close your eyes and just press buy or sell, either you win or you lose $2,000, $3,000. That's just what is very important. If that's the case, then the second thing is, how can I adjust now $100 to make $500, and how many times can I see it? And if I can see it 80 times, 50 times a month by trading 1 or 2 hours between Monday and Fridays, 2 or 3 times, for example, then of course I think it then it comes from quantity to quality, what is very important. You can see here something what is very important. First one, market is trending. Second one, you can see how the market is in a consolidation phase. That means here. Third one is the market is consolidating more, that the market is harder to trade. And the thing is just, if you have a trending market, you see that the market is going in one direction and it reaches a target. Very often number one goes to number two. If you see then that the market is wiggling around and it would still trend is very important, it will go to number three, it will be untradeable. And something what is just very important is that it doesn't go reverse. A number three market condition doesn't go to a number two or to a number one backwards. But a number one market condition goes to a number two. A number two market condition goes to a number three. This is just something what is very important to understand. And if you trade, for example, in the later noon time, it is not a big deal. It's just like you don't expect too much that a number one, for example, stays in number one. It's just like we very often have a number two in our process. So when we have number one, we don't need any tools. I think trading just any green candle between a lot of green candles make a lot of sense. We have sometimes short time of periods between number two, for example, where number one is happening, we can just trade a color switch. But number two, when we have consolidation phases and then we place the anchored VWAP on the bottom, the thing is just that we see then what color switches make sense. The problem is when your trading setup is to trade a red and a green candle, is that you have a lot of red and green candles. That means here, for example, here, up here, you have everywhere you have your trading setup, it's called. It is a pattern that we want to trade. And the thing is, you might get stopped out because the market is wiggling around. But with the help of this indicator that you're going to learn also within this video, this is going to be the anchored VWAP. We have then down here a color switch. That means instead of now having 5 times the opportunity to adjust $100 to make $500, you maybe only have 2 opportunities to adjust $100 to make $500. And these have greater quality. You first need quantity and then you need quality. And when you need more quality with an indicator such as the anchored VWAP, this depends on the market condition, what you see here. So we go now back to the chart here and you can see here that the market is more wiggling around. That means you see wiggling around, pushing up, wiggling around, pushing up, wiggling around, pushing up, wiggling around, right? Like every time when you see that, when the market is trending only like here, sometimes you have days it only looks like here. And sometimes you have days it looks like this, right? With many circles, many consolidation phases, these are called. Then the thing is, we need the anchored VWAP. This means we know exactly when we see step number 1 that the market goes to this area up here because of length. In this case, we sadly don't have a bigger structure high, but we have pressure. We have specific length. That means this length here. If we see that the market is going up to this area here, then second step is, do we see now lots of green candles with the pressure, right? Do we see that the market is doing number 1, 2, or 3 with the market condition? In this case, it's a number 2. So we need the anchored VWAP. We place the anchored VWAP always on bigger structured lows or highs, depends on what direction we trade. Trading up is going to be the lows, and we're trading a red and a green candle, and trading down is always the highs, and we trade a green and a red candle. Why do we trade color switches, a green and a red, or a red and a green candle? Because we can see the buyer side and we can see the seller side. So when we place it on the circle, the anchored VWAP, it will cut up like this, and then like this, what would be very good. And then like here, for example, instead of trading up here and being stopped out, we find color switches down here on the circle to trade up. I'm going to show you this one other practical execution. So step number 1, we have a bigger structure, higher low. Step number 2, we look at the structure. Do we need the anchored VWAP or not? Do we have a lot of green candles? What about the length back? What is very also important? We start reading the market. Look, for example, if you see the market has this length back here, this length back here, this length back here, this would occur also maybe here that the market has this length back here, somewhere in between. So we need to make sure that we have a line that is cutting in like this to trade up to this area here. The main target is to trade within this length up here. So this is the first picture that you see here, right? And the second picture, the first picture has always these 3 things. The trading time, it has the path, it has always a target, will be very important. Then you look at the market in this contracted view for 1 or 2 hours, and then you can see how the market really was doing this length here and how the market really was doing this retracement, right? So we want to place now the anchored VWAP here on this point here on always bigger structure lows. That means you can see here are the bigger structure lows, 1, 2, 3, for example, right? And you let the market cut here in, and then you will find here trading opportunities, or if you place it here, you should be able to find here trading opportunities. I'm going to show you this one. Here we are at picture number 3, and you can see how the trader placed here the blue line. This is the anchored VWAP. It is the volume weighted average price. It is calculating to your price and volume, what is awesome. That means how aggressive people are trading higher, and if lots of people wants to trade higher, this is something that's very awesome. It's like an average price you can imagine. And instead of trading here the red and a green candle here or there or here, you see how the market is coming back and does here a red and a green candle here. And when entering after the green candle here, stop placement down here, for example, right? If you have here red and a green candle and you would enter here, for example, then the thing is now on market condition 2, because it's more consolidating, push, consolidating, push. It will be important to have a rule set that every time you see the market is consolidating and pushing, either the market goes to a market condition where it's so hard to trade that you actually don't want to trade it anymore, or the market is consolidating and pushing good in a direction, but we need really to place this stop at the anchored VWAP. That means we need really to place it below the anchored VWAP, as you see, for example, here versus here. This is how to go with quality instead of too much with quantity. But you need in the beginning, quantity is something what is very important. Now, let me explain. When you sit down for 1 or 2 hours, it is very important. Did you saw more green than red candles the past 1 hour, for example? So it makes sense to trade green candles. Do you see a target reference where the market is going at? And then how many times did you saw a red and a green candle? Because you have always 2 things. This is step number 3 now. Entering after a green candle and the stop placement below is length. Position size is leverage. That means how much do you need to buy now to adjust this to $100? In the practical size, it's sometimes $75 to $115. You can't always say you want to enter the trade with exactly $100, but a tolerance of 20 or 30% it is. That means when entering the trade here, when buying, when you see like the green candles closing within 1 second, 2 seconds, you have a timer on the right side, stop placement on the color switch. If the market has now 3 green candles, 5, 6, 7 green candles, until here, for example, this would be $300, $400. But we want to have $500, and $500 maybe would be until up here. Let me explain. You can buy and you can sell, and you can also have a stop loss. If you have a lot of green candles, we want to buy after a red and a green candle. The stop loss should be here within length. Now, how much money you lose here depends on the length and the position size. That means we adjust the position size that this is going to be $100. How much money do we need for this? A $3,000 demo account would be totally fine. That means a not real money account first, just to do that, because when trading futures, you have $300,000 leverage for each $500 of margin in average. This is something that is really cool. That means if you have a lot of green candles and the market does here a red candle after green candle, we would lose $100. But within the next 5, 6, 7 green candles, as you see here, this could be $300, $400, $500, $700 just in our direction. So now, what is important for you as a beginner? As a beginner, I think it's very important to have the picture number 1 first. That means first these 3 things. When you start trading, the first 5 minutes, you make a picture in the beginning. The trading time 1 or 2 hours, you look the past 1 or 2 hours, how much length the market did and what direction, more green or red candles, taking notes about that. Using a path tool, as you can see here, to draw in what makes sense where the market is going at, as you see here. Then you look at the market contracted like this. Do not look too much at dojis, candle formations, whatever. It's not that much important. What is more important, to build a relationship to the market, that you look at it. Picture number 2, you can see then how the market, what the market did. You save these 2 pictures and you save of them 10, 20 pieces, for example. This might take you 1, 2, 3 weeks or 4 weeks. But the thing is, you need to know your market. You need to understand like which market conditions makes more sense that the market is reaching a specific target. Like here, for example, here you can see a bigger structure low, and here you can see a bigger structure highs here, for example. And if the market is down here and you see past hours, the market did this move down, this move down, this move down. If the market has the same move down, then it makes sense that it goes to the violet line. But the whole time the moves up, for example, here up, the moves up are just so less. It would need to do like 1 time, 2 times, 3 times, 4 times the move up until the market would really reach here this bigger structure high. Like such things with the direction that you just understand in what direction you trade. So after you did picture 1 or 2, you do picture number 3. You zoom in and you check out how many times, if there are a lot of red candles in the past and the market is moving down, or sometimes not end, because sometimes you have your mixed green and red candles, but you see here that the length down makes more sense. Sometimes you see the length makes less sense, but you see more green or more red candles. Sometimes it's the combination. This comes with the picture 1 and 2 with experience. The third thing is then, how many times did you saw a green and a red candle that when you enter the trade after the red candle and the stop placement is at the top? How many times did you saw that when you adjust your $100 that it could be $500? That means the risk reward ratio of 5. Or if you have green candles and you see red and green, that you have a risk reward ratio of 5 within literally to this target. That means the trader from here was expecting that the market is going from here to this target here. And you can see the trader saw one opportunity, two trading opportunities to adjust $100 to make $500. This kind of things is just something what is very important. After that, after reaching this target, the trader was assuming, as you can see with the gray line here, look at this one. Here's the gray line. He sees the market is turning around. He was assuming that the market goes back here to the 1-day VWAP. So you can see here how he took in here T1, and this was a risk reward ratio 1 to 5, adjusted $100. This would be $500 here. And then T2 here, the second trade here, you see a red and a green candle, lots of green candles here, adjusting $100, making $500. Additional note for you. If you see that the market is going down, the market usually does only 1, 2, or 3 green candles. When you see the market is going up, it should do only 1, 2, or 3 red candles. When you see more than 3 red candles more than one time, or more than 3 green candles more than one time, then this is something what is dangerous, what leads to a change of direction. So always think about these 3 things. Either it's trending up, trending down. If it's going up, you see more than 3 red candles for the second time, for example, or just one time. Or when the market goes down and you can see more than 3 green candles for the first or even the second time, then the market is very often evolving to the second thing. That means more consolidating, moving up, consolidating, moving down, where we need here the anchored VWAP as an indicator. Here we need no indicator, no AV. If the market does multiple times too much, like mixed with the colors, or too much of that, like green candles, 5 pieces of them, or too much red candles, 5 pieces of them in combination, or you see the market is going up and it does more red candles, or you see the market is going up and goes more with green candles, then the market is evolving from number 1 to number 2, and from number 2 it evolves to a number 3 where the market is going to be untradable. Intelligence is always being measured how much time it takes for you to take this information that you took now, because this is rate of learning, is watching this YouTube video. How much time does it take to you to apply this for your own trading? That means take notes, watch this video over again. Let me know in the comment section. I hope it was not too confusing with the information. And if you need any help on that, you can just look under this video. There's a link. If you go to tradewithjd.com, I trade live with students together. I build these trading performances as you see here. I give tasks. I look at them at the market live. I trade with them live. And so far it works within the first 3 to 5 months with them without prior experience, that they first can duplicate a $3,000 demo account or $1,000 not real money account first. And some people within the first 3 to 5 months, I got feedback that, for example, this student made real over $3,000 now after 5 months of learning.